Hey everyone, welcome to Bald Guy Money. I am Bald Guy, and 2 weeks ago I showed you all this. It's a list of the top 10 investable assets, not including real estate or the bond market, and at the time I showed you this, gold and silver were 50% of the value of the top 10 assets in the world, meaning together they were worth as much as Apple, Microsoft, Nvidia, Alphabet, Amazon, Saudi Aramco, all the Bitcoin, and Meta, the company formerly known as Facebook, combined. And what I also said in that video was that we were going to see a moment in the not too distant future when we see a shift, where people will pivot out of these companies and into gold and into silver as investors slowly come to the realization that the post-C19 bull market that we've been in is not a bull market at all, but a bubble built on cheap money and government spending of borrowed money. And what we saw this past week, although not a full confirmation of that, is a sign that we are getting closer to that shift. Companies with inflated stock prices began to sell off. For example, Amazon was down nearly 9% on the week, Nvidia pulled back nearly 6%, and silver and gold together increased their share of the top 10 versus what I showed you just 2 weeks ago, moving to 52% of the value of the top 10 assets on this list, meaning together, now they are more valuable than the other 8 on the list combined. And this supports a lot of the things I've been talking about here on the channel, not only about metals as an important safe haven in times of fear and uncertainty, and as you can see here, according to the Fear and Greed Index, the market is certainly fearful right now, but also that metals will appreciate in value relative to other assets, not only stocks, as I've just shown you, but also housing, which is entering correction territory and is already in a significant correction when priced in precious metals versus the highs of Q4 2022. So, since we've already covered the housing topic in great detail here on the channel, in this video, I want to explore the relationship between precious metals, so gold and silver, versus the stock market. I want to show you where we are today, and then I want to show you where I expect us to be by 2026. And before I get to this video's viewer question, which is on the topic of the gold to silver ratio, I will explain what I think the implications of this shift out of stocks and into metals will be, as well as what opportunities I see to make money, because I'm not writing off the stock market for good. So let's jump right into this with a look at gold, silver, and the S&P 500 year to date, meaning performance so far in 2024. And as you can see here, I've put their performance in percentage terms in green boxes to make it easy for you to see, with gold up 18.4% so far in 2024, silver leading the pack up 20% in 2024, and the S&P 500, which has had 3 down weeks in a row now, up only 12.7% year to date, which is coincidentally the average annual gain for the index since 2009 following the global financial crisis crash. Now, going by just these numbers that are here up on the screen right now, it's clear that metals are gaining value not only as a share of the top 10 assets, as I showed you at the start of the video, but versus the largest 500 American companies, which make up the S&P 500. But despite a strong 2024, if we zoom out to compare performance of metals versus the index since the 2000 dot-com bubble, you can see here that metals are still objectively undervalued versus the S&P 500 today, as on average, since 2000, it's taken only 2.1 ounces of gold to purchase the S&P 500 index and 145 ounces of silver, which is less than the 2.2 ounces of gold and 187 ounces of silver you need today. A fact that suggests, all else being equal, versus those average figures, gold is still undervalued by 3% versus the S&P 500 today, and silver, which we all know is criminally undervalued right now, and it's why my last 2 metals purchases have been silver purchases, is 29% undervalued versus the S&P 500. And if we take that one step further and assume the S&P 500 is fairly valued today, and I will swing back to that in a moment, what it means is that gold and silver should probably be at $2,510 an ounce and $36.89 an ounce respectively. But coming back to the topic of the S&P 500's fair value, the fact of the matter is that I think the index is overvalued. And I think the pullback that we've seen in stocks over the last few weeks is just the start of an overall downtrend for the S&P 500, which will fuel a larger upswing for both gold and silver, dramatically changing the value of the index when priced in precious metals. Because if we apply my simple PE ratio rule to the S&P 500, and for my new viewers, I used the same method in October 2021 when I correctly predicted the S&P 500 would pull back by 25% in 2022, and you can go back and check that video if you're curious to see it. But using that exact same methodology and assuming the S&P 500 with earnings where they are today should be priced closer to the average PE ratio since 1950, which is 19.5, then it would be reasonable to assume that we're in store for a 29% drop in the S&P 500 index, and that we should be pulling back to around 3,800 from the 5,346 level where we are today, and maybe even as low as 3,600, which would bring us back to the 2022 lows, as the market usually likes to pull back to important technical levels like that. And how this relates to gold and silver is like this. Last week, I showed you all this forecast for gold and silver prices out to 2033, which assumes we will repeat the run we saw from 2002 to 2011 with annual gains of 19.4% and 23.8% for gold and silver respectively. But if you look at the data closely, although I used average gains over the period to get to our destination, you can obviously see that in some years the gains are larger, and in some years along the way the gains are smaller and even negative in the case of silver for 2 of those years. And that's perfectly normal. Now, what this means is, and what I am expecting to see in 2025 and 2026 is, I expect to see larger gains on precious metals as interest rates come down, the US dollar on the DXY comes down, and the stock market as measured by the S&P 500 also comes down. As a result of that, I see 2025 and 2026 performing much like 2009 and 2010, where gold increased by nearly 28% in each of those years, and silver by nearly 70%. And what that looks like if we add those numbers to the table I showed you earlier is, and using some of my pricing models that I've shown you in past videos, I expect that we could see 25% gains for gold over each of the next 2 years, bringing us to $3,750 an ounce from here, and a flat 40% in each of the next 2 years for silver, bringing the price of silver right around my 2026 target of $60 an ounce. But more importantly, coming back to the point of this video, if these numbers track the way I think they will versus my expectations for the S&P 500, I expect to see the index, when priced in gold, go from 2.2 ounces today down to 1.2 ounces of gold in 2025, and then down to 1 ounce of gold in 2026. Now, for silver, with its more aggressive price moves taken into account, we could see the S&P 500, when priced in silver, go from 187 ounces today down to 86 ounces in 2025, and then eventually down to 64 ounces of silver in 2026, which, if we look at the period from 2007 to 2009 on the table here, not only looks realistic, but it also suggests that there could be room for more movement to the upside for the prices of metals, as we saw that ratio narrow even more in 2011, as it took only 0.8 ounces of gold and 36 ounces of silver back in 2011 to buy the S&P 500 index, which is great news for both silver and fractional gold stackers because it shows just how valuable metals can become in an environment of uncertainty. And to my fractional gold stackers out there, please don't forget to tell me what products you like to stack in the comments section, as I want to know what to offer deals on once my new venture launches, the venture that I'm cooperating with, and I will be announcing what that is on the channel soon. But I do want to say that it is aimed at making metals ownership easier and more profitable. So again, just let me know in the comments section what fractional gold products it is you want to see deals on, and again, I'll see if I can make that happen. Now, one last thing I need to cover before we close this topic and move on to this video's viewer question, and that is for those of you who are in mining stocks like I am. Since mining stocks are really a leveraged play on gold and silver, meaning when the price of metals goes up, the miners yield an even higher return, and when they go down, they lose even more in proportion to gold and silver. And anybody who's been buying mining stocks recently knows that lesson very well. If we see this scenario play out as I've shown it in this video, it could make for an epic swing trade if you want to sell a portion of your miners to get into the beaten down S&P 500, which at the pullback levels of 4,000 and below on the S&P 500 index, I become a buyer of. And for the sake of transparency, I will fund part of those purchases by selling some of my profitable miners at that point. So I just wanted to share that bit of my strategy with you all here right on the channel, because it's the same strategy I used when I sold off my tech stocks for big gains to buy beaten down mining stocks in 2023. So with that covered, it's now time to get to our viewer question for this video. And remember, you can submit your question in the comments section of this video or any video I do, and it may just appear in a future Bald Guy Money video. And this week's question comes from Le Magnum. And Le Magnum is asking why I don't factor in the historical gold to silver ratio in my work, since where we are today is out of alignment with where we have been historically. And I get variations of this question from time to time here in the comments section on the channel, and I think it's an excellent one to cover considering some of the analysis I've presented in this video. Because I assume Le Magnum is specifically commenting on the gold to silver ratio of 58 ounces of silver to 1 ounce of gold that came out as a result of my 2033 price forecast analysis from last week's video. And Le Magnum rightfully points out, when we compare that ratio with the 12 to 1 used by the Romans, or the 15 to 1 that was used in the Coinage Act of 1792 in the young United States of America, or even the average ratio during the 20th century, so the 1900s, which was a ratio of 47 ounces of silver to 1 ounce of gold, it seems my expectation of 58 ounces of silver to 1 ounce of gold by 2033 is on the high side. That is until, of course, you factor in some important points. Starting with the fact that since Richard Nixon officially took the United States off the gold standard in 1971, the market has been free to price gold and silver as it sees fit in line with supply and demand. And I know there are many of you screaming about silver manipulation as I say that, but let's be fair and honest with each other. The gold market, just like the silver market, is also manipulated. It would be unfair to say otherwise. And as I see it, even though I know silver comes out of the ground at a ratio of 8 ounces of silver for every 1 ounce of gold, the free market, specifically the wealthy, and that includes central banks, value gold more than they value silver, especially when you factor in the impact that central banks have when they come into the market to bid up the price of gold, along with the ultra wealthy, two groups that are statistically less likely to stack silver. And in the case of central banks, they really don't buy silver at all. And although I agree where we are today with the gold and silver ratio is a bit out of whack with where I would expect it to be, and I say that as we switch back to the GSR chart from 1971 to today, I will repeat that I have said in past videos a gold to silver ratio between 40 and 60 to 1, where 40 to 60 ounces of silver equals 1 ounce of gold, is a much more realistic expectation considering how the market has valued them relative to each other since 1971 than expecting the mining ratio of 8 to 1 to be the fair price, or any of the other man-made systems to be a fair measuring stick of what the ratio should be. Because in my experience, I trust free market price determination much more than I trust any other method, especially those decided on by governments because they have the worst track record in trying to determine the value of things. So, Le Magnum, that is why I don't take those historical man-made ratios into account in my analysis. It's also why I don't think the mining ratio is a great guide, and you can see more proof of that in the price of platinum, which is lower than the price of gold, despite the fact that it's actually rarer than gold. And that's a whole topic, different topic altogether. And if you want to hear me say something about that, you can request that in the comments section, of course. But just to close the case of silver, I want to say to you, Mr. Le Magnum or Miss Le Magnum, I don't know who I'm answering exactly, but I want to say yes. I think silver is undervalued, but not as much as some other YouTubers think so. And I'll simply let time decide, as well as the free market, who is right. And with that said, that's it for this video. Thank you all for taking the time to watch this content. If you liked it, please leave a like. If you want to give me some feedback or ask a question, please do so in the comments section now. And if you think this content is valuable and you think somebody else should hear this message, please take a moment to share this content with those people, because all of your support has made this channel one of the fastest growing, if not the fastest growing, precious metals channel on YouTube, and I want to thank you all for your support. And until the next time we see each other, everybody, please take care of yourselves and take care of each other. Have a great day ahead. Goodbye.